I've been getting many requests recently to share the spreadsheet that I use to conduct my discounted cash flow analysis on stocks that I've been reviewing on the channel. I responded to a couple of you by saying that I'm planning on releasing an online tool or some online access to my spreadsheet that I use so that you all can use it. However, developing that tool and that access is taking some time. So in the meantime, I've decided to make my spreadsheet available to all of you. And in this video, I'm going to show you exactly how to use my spreadsheet to perform a discounted cash flow analysis and the corresponding pillar rating system by inputting financial data on any stock that you want to evaluate. To access this spreadsheet, you need to go to the description of this video and click the link that I have there. It will bring you to a OneDrive shared link where you can download the spreadsheet, which is my proprietary tool. It's actually the fourth iteration of this spreadsheet tool that I've created. So you guys aren't getting the first version, you're getting the fourth version. That's why it's called DCF Analysis Model 4.0. So before you continue watching, if you want to go to that link, download the spreadsheet and follow along with me while I teach you how to fill this out. I'm going to be performing a live beginning to end valuation of the stock UNH United Healthcare. Let's go right to it. Okay, so here is our spreadsheet, and this is the first page, General Info tab. You'll notice that I've saved the file with the current month, February 2024, and I've saved it with the name of the ticker symbol UNH. Now, the first thing you're going to notice is a couple charts. This panel right here with the margin of safety and the prices that will appear once we're done with our analysis for each discount rate. In order to begin with any company you'd like, you need to type the ticker symbol into this box right here where it says enter ticker here. If we wanted to, we could change this into Square, for instance, and it would update all of the information once we set this data field by clicking on this question mark and selecting the correct stock here on the panel that appears. So block, that would update. It would update all the price information. It would update all of this information about the stock, including the number of shares and the current price and market cap, which is really important for us, and the ticker symbol, which is going to be important for utilizing the embedded links in this document. So it's really important to put the stock that you're analyzing right here to begin with. So for us, that's going to be UNH. So I'm going to go ahead and back up here and you will see the information appearing. Now this price chart is actually pulling from the price tab where we have an automatic function that is pulling in all of the stock's price history going back to 2005 through Excel's stock history function. So you can see the chart there, the extended chart, and this is a log function of that, and it reports the same thing on the front page, a little bit squeezed. We're going to go ahead and enter the data, the financials, just for documentation purposes. The last financial release was ending September 2023, so we go ahead and enter that there. There are some stocks right now that are releasing financials for December of 2023, so if you're dealing with those quarter four financials, you can enter that there just so that next time you open this worksheet with this ticker symbol on it, you can check to see, oh, what was the last financial records that I evaluated this stock at, just for documentation there. And the next tab we're going to go to is going to be the free cash flow tab. This is one of the most important tabs. And for all of these tabs, what's really cool about this spreadsheet is that I have embedded links that are based off of that stock ticker symbol that we entered in the first page. And so when you click on these links, for instance, shares, we need to put the shares outstanding data into these fields here, and we need to put the price to free cash flow information into these fields here as they are shown on Macro Trends website. So when I click on the shares button on the link there, it's going to open up this URL to Macro Trends for this particular stock. So if we had entered a different stock ticker symbol, it would automatically update that URL and bring us to the Macro Trends page for that stock and that information we're looking for, which is shares outstanding. And you'll see on this page that we can scroll down, we can see the little chart that they show there, but we're just going to copy our data. If you keep scrolling, I have ads blocked, and so if you don't have ads blocked, you're going to see some ads slowing down the page maybe for you. So I recommend getting an ad blocker for that. Macro Trends is awesome, and the way I've set up the workbook, you just copy the data, quarterly data from Macro Trends. So I highlight everything, click copy, and I'm just going to go back over to my workbook and paste the data in. And I like to match destination format so that it just keeps everything looking all the same. It will paste the data in quarterly, just how the workbook needs it, just perfectly. So we don't need to format, we don't need to do anything. I'm going to go to the price to free cash flow page. That's going to open up another macro trends URL, and I'm just going to do the same thing. These pages are really awesome to just visualize the stock data. In fact, a lot of times before I start analyzing a stock, I just click through macro trends and look at the price to free cash flow history and the price to free cash flow ratio. It has it all on this page. The price to free cash flow ratio. It shows you trailing 12-month free cash flow per share with the price to free cash flow ratio there. But again, we're just going to go to the most recent financial quarter, which is September of 2023. And we're just going to copy from that line all the way down to the end. And their data always goes back to 2009. I think that's good enough for our purposes of analyzing these stocks. And I paste it into the workbook. You'll see automatically that the chart that's displaying on the right-hand side is filled in with the financial data. Now, this chart carries the 12-month rolling average of free cash flow as well as the trailing 2-year average annualized free cash flow. So it's a little bit of a smoother line there. And that's what I show on these videos when I show trailing 12-month and trailing 2-year. It's because I just put in a formula to average that data and to smooth the line for us so we can get a little bit of a better picture, because free cash flow tends to go up and down a lot more than net income and especially more than revenue. Now, these fields here that are shaded in yellow are fields that we are going to fill out later after we've completed filling in all the rest of the tabs. So right now, leave them blank and we'll come back to them. We're going to move on to the return on invested capital tab, colored purple, and we're going to do the same thing. Just click on the hyperlink here. It will open up the macro trends page, scroll down to the data table, and in this case, it's showing December data. So it doesn't hurt to just copy that for this, but if you want to be consistent, you can copy over from September only. And so we have our data pasted into the return on invested capital page. That's just a simple step that helps us see what their return on invested capital trend has been. For dividends, I'm going to click on the link again. This is going to give me annual dividends paid. Again, I scroll down. I'm just going to copy the years we have here. Now, their data only goes through 2022. So what I'm going to do is I'm going to paste that in the 2022 row. And for 2023, I have a little function here. And if you click on the equation, you can see exactly what's happening. It's summing the most recent quarters of the current fiscal year, and you can enter the corresponding quarters of the previous fiscal year so that you can project what 2023 is going to be on a yearly basis. So for that, I'm just going to draw a box around this so it's easier to see. And even though there's 4 quarters drawn in there, we're only going to use 3 quarters. And for that, I'm going to click on the quarterly button. I'm going to switch on macro trends over from annual to quarterly. And actually, when I click on that quarterly button under the cash flow statement, at the very bottom, you can see common stock dividends paid. And in this instance, they're going to show me what the annual dividends paid is ending in December 2023. So it looks like they have some data in for December, but not all of it. In whole, we're looking at up to September data. So I'm going to do this as if we only have through September's data. So I'm going to enter September, June, and March from 2023, which is 1738. And the quarter before that, which is 1739. And the quarter before that was 1747. And the quarter before that was 1537. And going back to 2022 in those same corresponding quarters, let's see, I have September, we have 1545 and 1363. So what it does is it computes a value for 2023 for the year. And that's the way of forecasting what an annual dividend would be if you only have 1, 2, or 3 quarters of data in for that year. Down here, I'm going to click another link just to help me visualize the dividends. And that's going to link to a NASDAQ.com URL, which gives us the dividend history by quarter and by special dividends. So I'm going to copy all of that information down to the bottom and simply paste it in And it should automatically fill in the chart here, which shows the dividends increasing ever since 2009 or so, dramatically. I'm going to click on earnings next and click on the link, which again will bring us to macro trends. Scroll down and copy the quarterly data. Again, this data is actually pulling in from December of 2023. So we have some updated data there for net income. Same thing for revenue. And you can see the link here, and it's built off of a formula that takes from that first general info page. So you can see how that formula is being created, and then the data link here has its own formula that's pulling from that. So I'll copy the revenue data by quarter and simply paste it in. There's one more tab that we have to fill in before we start looking at things in detail, and that's the balance sheet tab. And the important thing is when you open up the balance sheet on macro trends, it's important to switch from annual to quarterly just to make sure you're getting the most recent quarter. So instead of that 2022 final quarter, because that was the most recent full annual year balance sheet info we have the third quarter of 2023, the ending in September balance sheet information. So we're going to enter all this information in. Keep in mind that we need to enter this in just how we see it on macro trends. So in terms of millions of dollars. So I'm going to type in 44,097. That's going to represent 44 billion. And you can round this if you want to. For inventory, I'm going to write 0 because they're showing none. Current assets, I'll just write 91,900. Property, plant, and equipment is 11,000. Intangible assets are 117,000. I'm rounding some of these, as you can see, 282,000. Current liabilities are 114,180, and long-term liabilities are 78,320, with the total liabilities of 192,500. And so what you can see is we have all the balance sheet information entered, and something happening down here is the net quality assets is taking an adjustment from the difference between the total assets and total liabilities, but it's taking away from the total assets some of property, plant, and equipment, some of intangible, and some of inventory, in which case this one there's 0. But those corrections are being done in this formula. So what you're seeing here is a conservative version of their total equity or total booked value, so to speak. And of course, it's dividing it per share, so you can just visualize right on this page what makeup of their total stock price should be just what's on their balance sheet today. So $31 per share. If they never made any cash flow from here to infinity, if they made $0 in cash flow, you could liquidate the business for a conservative estimate of $31 a share. And of course, you can go into this formula and change these values slightly. If you have a company that relies a lot more heavily on intangible assets, United Healthcare does have a lot of intangibles, and we're subtracting 30% of those when we're doing our adjustment. So that's kind of a lot, but I like being conservative. If you have companies, sometimes their property, plant, and equipment is higher, sometimes their intangibles are higher. The point of this equation is just to take away some of those parts of their assets that are not easily liquidated, or if the company was in trouble, those assets would be written down some. So I just want to be extra careful. This comes into account a lot more when you're evaluating banks and financial stocks. You really want to make sure you do corrections for the balance sheet so you're not overestimating the risk involved with all the assets that are on their balance sheet. So with every tab completely filled out, you can ignore the lists tab. It's just a placeholder. We're going to go back to the free cash flow tab, because there's some important information for the discounted cash flow analysis that's on this page. And you can really see that when you look at column S through AD. You can see that we have listed the free cash flow estimate into the future years all the way to the year 100. So 100 years from now, we're forecasting free cash flow all the way to there. And you're going to say, well, how are we going to do that? Are we going to input those manually? No, we're going to have some fields here that we fill in, and it will automatically populate these cells. And in column U, V, W, and so on, we have a discount rate. So for each of these various listed discount rates, we're going to see the equivalent discounted free cash flow for all those years. So I'm letting you know ahead of time, but once it's filled in, you can take a look and it may make a little bit more sense. So what I really want to do here is I want to put in a base year free cash flow from which we're going to project all the free cash flow from into the future. So the thing I want to do here is I want to capture what is their free cash flow today in this current year that we can project from with a good level of confidence. A lot of times I like to take what their current free cash flow is right now and just discount it a little bit. So I'm starting with my own personal comfort margin of safety from the base year projection. So I have a gray field here that has the average of their last 2 years of free cash flow on a quarterly rolling basis. So that $22.7 billion in annual base year free cash flow is an estimate. You can actually see that in the trailing 12 months, they're at about 26 billion. And a lot of times I like to look just in the range that's underneath where they are currently, just in case they decline right now, 10%, 20% right now in the current year. Maybe not 20% for a company this stable, but that's all part of that art of investing that you need to have your own personal convictions. Yeah, I corrected enough. I anticipated enough on the conservative side. So I'm going to go ahead and trust my valuation instead of being on the optimistic side, instead of being overly optimistic about a stock or just taking it at face value. We are going to enter something a little bit less. So when I'm looking at this chart, I'm going to enter 23 billion. I think that's a very comfortable place for me because they're at 26 right now. 23 would mean if they came down a little bit. Actually, you know what? I'm going to be extra safe and say, let's start with 22 billion. Now, they could have a recession in the next year and they could crash all the way down to 15 billion. And I could be overestimating this, but we don't want to live totally in the dark ages as far as our conservative estimates. We want to be realistic, but a little bit on the conservative side. And I think this 22 billion is actually going to get exactly what we want right there. The next thing I need to do is fill out the growth rates that I anticipate for this company over the next 5 years, and then in the medium term between 5 and 20 years. And then the perpetual growth rate is going to apply to all the years after 20 years in the future forward. So you're going to see like year 1, 2, 3, 4, 5 are going to be based on the first 5 years growth rate. And then from year 6 through 20, it's going to rely on that middle growth rate you enter. And after year 20, the growth is going to be based on your perpetual rate. And in order to give you a clue for what to enter here, we have some historical rates already pulled in and averaged right here. So you can see over the last 1 year, their growth was 21%. Over the last 3 years, their average annual growth was 22%. And it goes all the way back to the last 10 years. Sometimes I like to look at this average where I'm just averaging between their 10-year growth rate, 5-year growth rate, their 3-year growth rate in 1 year, and just putting them together. A lot of times companies grow faster in the past, and companies that are maturing are starting to grow at a slower rate than they were 10 years ago. So in that sense, it's good to look across these and make a guess about the next 5 years that makes a lot of sense based on the trends that we're seeing. In this case, the company has grown over the last 1 and 3 years faster than it grew over the last 10 years. So it's really not slowing down its growth. We can say something very conservative here to say like, let's anticipate over the next 5 years, it's going to continue to grow at about the rate that it did over the past 5 years, but we're going to bump it down just a couple of percentage points and say 15% sounds great to me. Another way we can double check this, and the whole reason I put these tabs in, is to just take a look at the earnings tab. And you can see over the last 10 years, they grew at 15% per year in earnings. So that kind of matches, okay, they'll grow over the next 5 years about that much too. And just in case you're concerned, like look at their 5 year and 3 year there over the past few years. 13% sounds good. Okay, maybe we could bump that down a little bit, but let's take a look at revenue. Oh no, revenue's even gone up 14, 15%, 14% in the last 5 years. So I think 15% for free cash flow growth is actually really accurate. It could grow faster, could grow 17. If you want to be optimistic, you could be optimistic. If you want to be pessimistic, you can be pessimistic. And just shift those assumptions around and see where the company is valued under those different circumstances. That's always a good technique. But for right now, I'm going to use my basic assumption of 15% over the next 15 years. A company like United Healthcare, When I think about a company's perpetual growth rate, it should never be more than 3%. If you do 4%, you're really testing the limits. So I think 3% is really the max you want to do. 2% is something you would use for a really good quality company that will be around in 100 years. But we reserve lower perpetual growth rates and even negative perpetual growth rates for companies that we think might not be around. After 20 years, they're going to be declining. They're going to be going away. And so a lot of companies really should have negative perpetual growth rates, but a lot of the companies we analyze, they're such good quality companies and so robust that a lot of times we end up giving them a 1, 2, 3% perpetual growth rate. I think a company like United Healthcare, from now through 100 years from now, I think they're going to be around. I mean, of course, we have no idea what's going to happen in 20, 30, 40, 50 years. But if we use a basic assumption that says, hey, this is a giant in the healthcare industry field. I mean, they're going to be around in some way or another in 50 years, in even 70 years. I mean, they're just so big at this point that there's really not a lot that can stop that. Of course, every business can be disrupted. But when I say something like that, a company that's just so robust, so entrenched, I like to give it a perpetual growth rate of 2. If I really think there's no chance the company's going anywhere, I'll give it a perpetual growth rate of 3. Or if I think it's very crucial to the general economy, like it's a company that just has to be around because people need to eat, or they need wood or lumber, or they need raw materials. But in this case, United Healthcare, I'm going to give it a perpetual growth rate of 2%. And I like to do the perpetual growth rate first because I like to put the medium-term growth rate somewhere in between that makes sense. It's going to go from 15% average over the first 5 years to something lower than that, and then eventually it's going to trail off at 2% into perpetuity. So for medium term, I like 8%. Now, where did I get that from? I mean, we could have put in 12% right there. But I think once a company starts to mature, we're talking about from 6 years from now until 20 years from now. You're talking about a company that's going to have grown so much that it really can't grow too much more. You can put in whatever value you want here. You just have to make sure that it makes you comfortable to sleep at night when you've done your full valuation. And then when you're basing your investment decisions on that, you have to say, have I thought about this every which way? And I agree that that's an appropriate growth rate assumption to use for the company, because that's going to determine its intrinsic value. For me, I think an 8% from year 6 to year 20 is appropriate for United Healthcare. The company's growing. It's going to continue growing a little bit slower than it is now, but high single digits is very fair to me. The last thing we need to enter is our assumption about the shares that they're going to issue or buy back going into the future. And so we have a first 5 years and then a perpetual rate for that. I think for the perpetual rate, we can use something that's similar to the average of these values here. And over the last 10 years, you can see, and I even have a little chart down here, you can see they've bought back shares at various times. They're even buying back shares now at a slower pace, but still, you can say about 1% per year over the last 10 years, they've been buying shares back. So I see that going forward into the future. And, I don't really see anything different in the first 5 years either. So I'm going to use a 1% buyback rate for that period as well. And that is it. We are done. And you can take a look at what's going on here in these cells to kind of get an idea of what I was talking about earlier. In the first column T, it's showing the projection of nominal raw free cash flow for this company. But in each successive column, it's going to show that exact free cash flow in each year discounted at a certain rate per year. So under a 5% discount rate, each of these values are discounted at that 5% per year. And so that's why when you get out to 20 years, for instance, instead of 154 billion, well, when you discount at 5% per year, it's really only the equivalent in today's dollars of $61 billion. And when you discount that same 154 billion at 10% per year, you're only talking about $25 billion in today's dollar value, and so on and so forth. So that's going to really inform what happens on the first page, the general info page, which is where we're going to end up at the very end. And the last thing that we really need to decide on is the margin of safety discount that we're going to use. So all the valuations for all the discount rates, we're just going to step them down. We're going to just step everything down by a general margin of safety that makes us feel comfortable. We did a little bit of this conservative estimation when we put in the base year free cash flow, and we did a little bit of this when we were talking about the projected growth rates, but this is going to be a final safety factor on top of everything that's just going to make us feel so good that we've put in all these safety factors, and if the company's still fair value or good expected returns based on the discount rates, then we really feel comfortable about owning them. So the margin of safety is going to be different for every company, in my opinion. A company that's very stable, very steady, very projectable, something that you're sure of your projection of their free cash flow, I feel like you can use a lower safety factor or a higher ratio of the margin of safety discount. All this number is saying is we're going to take all the estimations and multiply it by that factor. So if you multiply it by 0.5, that's reducing everything by half. But if you set it to 0.8, that's only going to reduce it by 20%. So we're just multiplying all our values by that margin of safety discount. And so I tend to pick 0.7 for a typical company, for a typical stock. But a company like United Healthcare that's really stable, really predictable, and you can see part of that here in the pillar ratings, which we'll talk about in a second. But you can see that except for their current PE ratio, everything else is so stable, so solid, lots of green check marks, that I'm going to set this to 0.85. It's one of the highest margin of safety factors that I end up giving, or rather the lowest correction that I end up giving. I give larger corrections for less certain companies, smaller corrections for more certain companies. United Healthcare is going to get that 15% slash. So everything we've calculated, just reduce it by 15% for everything. And that's going to give us this value in this column. So after the margin of safety is applied, you're going to see at each discount rate here, starting from column D, you can run it all the way across, and you can see in this column what you should pay for it given all the safety factors on top. So under a 10% discount rate, $850 a share is what you should be willing to pay for it. And at a 5% discount rate, you should be paying $3,000 for the stock. Well, currently the stock's priced at $527. So we can tell that the market really has it priced a lot higher than a 5% discount rate. Now, where I get my idea of the implied annual expected return is when we see this ratio between the current price and the value at a given discount rate, where we see that value, that ratio equal to 1, that is the discount rate that balances all their future free cash flow when you combine their current assets and book value, equity. So equity plus free cash flow, the discount rate that balances that free cash flow side of the equation with their current price is the expected annual return. And so that would be the annual return I would expect to get from the company by holding it today or at the current price. So you can see that it's somewhere between 10 and 15%, probably closer to 15%. So in this case, I can create a little diagram to interpolate where that value crosses the 1.0 threshold. It's probably going to be about 14%. So when I take a look at this company, when I use the assumptions that I used, I expect a 14% annual return if I bought United Healthcare today at the current price, which is pretty good for such a stable company. Now, in general, you want higher expected returns, but for a company that has a lot of these pillars checked off, you might accept a lower expected return rate. Something around 10% might be good for you if you have a lot more conviction and certainty in it. And that's where we get our pillar system. The pillar system is really just a list of rules that we apply check marks to if they meet those rules. And it goes from everything to consistency of revenue and net income to whether the shares outstanding are being diluted or being bought back. Being bought back is a good thing. So shares outstanding decreasing is a good thing. It also includes their debt, their balance sheet, like long-term liabilities being less than the last 5 years combined of free cash flow, and the quality assets being greater than the total liabilities. So the adjusted assets being greater than the total liabilities, or their cash on hand being greater than a third of their current liabilities. We also have their free cash flow consistency and that ratio between their market cap and free cash flow, kind of like the PE ratio except for free cash flow, which they actually have a check mark there. So we can say that it checks 7 of the 8 main pillars and 18 of the 21 sub-pillars, which is a really good quality company. The only place that it falls a little bit short is right here on the PE ratio. It has a PE ratio of 27, but the trailing 1-year PE is 22, which is actually pretty low for such a good quality and growing company. So overall, I really like United Healthcare. I mean, 14% annual return doesn't really get me all that excited necessarily, but if you're looking for a really good quality company and you're looking for something that will give you consistently above 10%, close to 15%, and you like a little dividend return, you like a company that has a really high R-squared value on their price chart, which means that their price doesn't fluctuate way up, way down all the time, that it's very consistently growing, this is a stock that might meet your criteria. So anyway, it all depends on your investment goals. It also all depends on your assumptions that you plug into this spreadsheet. But this spreadsheet helps you to take your assumptions, it does all the mathematical calculations for you, and it spits out the values there for when you apply a margin of safety, what is the price per share that you're willing to pay for it at various discount rates. And the spreadsheet also automatically calculates all of the pillar ratings that I've created. 8 main pillars, 21 sub-pillars. So with this tool, hopefully you will be able to evaluate stocks on your own with a lot more confidence. And of course, let me know what you think. Let me know if this helps you. And let me know if you find any bugs in the spreadsheet that I can help fix. There are, of course, going to be little quirks here and there that I'm used to that maybe you aren't. So again, if you run into any questions, just leave a comment on my video or reach out to me on Twitter. I would be happy to help you. And with that, I hope you all have the best of luck investing. I'll see you next time. Take care.